Hello guys, and glad to have you on board again. Today, a quick update regarding the underlying scenarios presented yesterday into the weekly updates. First, we start with the stock market, which is in the middle of a very tough situation. Yesterday's scenarios are not yet invalidated, and still they are tricky to navigate, the usual low volatility stuff and heavily speculated markets. We're going to talk about this and what to have a look at, but today contents is mostly going to be for experienced traders in order to be traded. Okay, so active trading activity must be limited to some expert traders. Otherwise, I'm still releasing that video for the general public, because I think despite trading it, okay, so please do not trade it actively with your money, but have a look at some very precise assets today and tomorrow, because interesting things might happen out there. Or it might just be a non-event, but I have a lot of information pointing to a direction that something big is about to show up within the next few days. And this is where to look at. Okay, so basically the stock market reacts pretty weirdly, trying to completely fuck up this third range boundary area we've highlighted in here. Pretty easy to figure out, actually. It was just not triggering any variable signal to reverse the market, but it was definitely an interesting context to navigate. So first things first, this area matters a lot. If we ever retrace out there today, which I think we very likely will, whatever happens out there is going to matter a lot. Until then, we had a technical area. It really matters to see how the market reacted. Well, not at all. It didn't even react, so nothing ever showed up, and right after the market decided to accelerate, this is what this little breakout signal in here tells us, trying to install prices over previous historical highs. So the big question in here, do we have a squeezed third range boundary area? Well, remember that the squeezed pattern requires the market to install value over the previous high points. I wouldn't call for this to be such a thing, because actually, to be honest, the only thing we've done in here is just accelerating through the trend channel. That's the only thing we've done. So we just have a steep trend channel in here, meaning that the bulls are just raging. Okay, but that doesn't mean they have control over prices. All I see in here is that they have a bullish cycle, and they did pretty well with that bullish cycle, but they are now facing heavy resistances. Though are they going to find sufficient fuel to get there? I'm not sure about it. So the second area to look for today is, can we set value above the resistance context? That would be a sign that the bulls have some strength and still some gas in the tank. Otherwise, if we ever retrace to yesterday's area, so today's speculative areas for the S&P 500 is, do we settle value out there? If that's a yes, then the bears lost the battle, or very likely will, and I will probably take a stop loss associated with that. Comes along with every speculative trade, so if I'm the wrong direction, just get out, okay? Second option, we retrace to yesterday's area, which I think we very likely will, and there is a big question mark. Are we going to rebound out of it, because those who sold this area will buy themselves out, okay? Option number two, we do not buy, and we keep pushing down, sending the message that the market rejects value into this area, and in that perspective, every short seller, me included, will be able to safely put a stop loss over this market top, which means lots of short sellers will enter with top losses over this market top, and they will very likely target pushback to the previous supports. Okay, so that's the price action to look for today. If you took yesterday's third range boundary, you should still be in, and invalidation is still not a topic at the moment. We're just waiting to have confirmation that the market has flushed out this area by setting value over the previous high points, which so far we fail to do. We just pushed one way higher, and that's the reason why every third range boundary trading comes with a large stop loss. And in here, due to the enormous length of the trend channel, that means you have a very large stop loss and a tiny position sizing. This is why the indicator adapts to market conditions, so that you can adapt as well. accordingly. So in here we know that the risks were high, it meaning be trading without signal, which I did personally, though I knew I had to take tinier position sizing, and the stop loss must have been set very large. Okay, so as of right now, taking in the chaos and waiting to see if the market is just trading against me and I will just get the hell out, or if I am in the right position. Okay, so that is for the S&P 500 active trading for those who got into the third range boundary. Don't panic. I mean, chaos is there, and if you just change your mind anytime the market doesn't go exactly as you want it to be, well, this means you still need a lot more experience with third range boundaries. Okay, what I'm personally looking at to orientate risk limitations into these very tricky areas is the couple dollar with 10-year yields, because we've had quite some concerning different signals yesterday. Into this area, the 10-year yields is still trading sideways after building a very weird double bottom structure inside the context, which means we failed to trade below the context. The moving average is below these support contexts, and we have a very likely probability to build a support in here. We have trending signal on an average price. So that means the market rejects average valuation and might be looking for volatility into the opposite direction. Very likely going to reverse the higher time frames trend channel. Okay, so I suspect this is where the market wants to go, right around 2% in 10-year yields without getting too crazy about it. This is not the end of the world. This is just an average 10-year yield valuation in the current situation, and that would be just absolutely normal. So I think the market is settling for this area. Though expert traders only, we are trading 10-year yields on a reverse pattern, trying to look for probabilities of the market to reverse into this area. Those who know how to trade reversals will know that this is definitely hell of a structure we know about, and this is the third range boundary we look for as a validation and confirmation that the market is building its reverse pattern. Which means if we ever hold on to the latest few days supports, and if we ever break a resistance, okay, so if we ever break 1.30, just getting out there will mean we break it, okay? It's going to be the validation sign and confirmation will be closing above 50% context. Okay, so if we ever close into this area, H1 time frame reference chart here means that we have a bottom in place, meaning that we're very likely settle toward 2% in the future. That doesn't mean we're going to get there in a few days, okay? But the current area is absolutely tricky for 10-year yields, though if we ever get a signal today, you definitely don't want to miss it. So put an alert, and if we ever get H1 time frame candle closes above the 50% context, that is something that matters. Not something for you to trade, but that means something is playing in the market and that an information has been sent to smart investors. On the opposite direction, if we were to reach out 76% and closing out there, that would be a concern that the fact that the yields have changed course to eventually get to break below 1%, which I definitely don't think is on the verge to show up, but I mean, you need to be open-minded, okay? So if we ever succeed closing context timeframes below these levels, okay, so closing below the box when the box closes, so that means this is daily updated. So if today we succeed closing below 1.22, that means the yields send a message to the downside, which I do not like because that's not the side I'm trading. Yesterday has been an important day as well for dollar, because dollar has sent us quite an opposite signal, a negative signal yesterday, in which markets try to accelerate in a resistant context around average valuation after a bearish trending move on the trend channel. Okay, so trend channel reference closing multiple times below. Okay, then we've got a mature flat range, two sets of waves retracing to the context average value. We're trying to accelerate with lack of signal. Okay, so this is not the best case scenario, but still this is pretty damn bad for those who were buying dollars. So expect the market to eventually range into this area, but same thing goes in here. Look at 2 time frames below. Okay, definitely ugly reversal pattern in here for those who know how to master these. Okay, and we are validating because we are reaching the opposite context. So in that perspective, okay, as long as dollar do not break 93.8, if we ever succeed breaking any support within the next few days, means definitely a red flag is there for those who are supporting the dollar, which means a big problem ahead, because if we have rising yields and deteriorating dollar, which I definitely think is the major market move, that means the market is pricing stagflation, and stagflation is the worst possible context for giant technology, because that means rising yields, okay, when in the same time we've got the dollar trying to compensate. So in the first stages of these types of markets, it definitely looks exactly the way Apple is trading. It looks like it's bullish because the dollar might be going down, so that may create a base value effect from the currency, but in the same time yields are rising, and that definitely means in here that growth will reduce. And in that perspective, that means inflation with limited growth, and that means the market will start anticipating that the profits curve on these big techs will start to dampen within the next quarters. Okay, that means there will still be far the most profitable companies on earth, but that means the growth, the rhythm of growth will slow down, and as prices follow the growth, prices may deteriorate as well. We have an ugly distribution pattern in Apple, the same one that has destroyed Bitcoin the last time. It's exactly the same. I mean, just look at that. It's just different time frames, okay? But you got 3 consecutive market tops with converging trend line building some kind of a wedge, okay? The final wave fails to reach out the market top, which everyone thinks we will. We do not. Then we break the structure and immediately focus support with a very volatile manner. Then we somehow retrace half 50% or even less than that, and the second wave is the deepest one that retraces right back to the previously traded range area. Okay, take that information, put it into Apple's context, and you have a recipe for disaster. Okay, so first, second, third trend line, trading below it, everyone thinks we're going to reach it. We've got the converging trend lines. First set would be breaking out of this area, retracing, and going right back to the previous traded range area. Okay? No cheating, no shit Sherlock. If we do this, that means within the next few weeks, we're going to get a 25 to 30% drop in Apple. That might change people's psychology, and that also means that this won't be the end of it, because we might retrace down to 50% over the market top for Apple. Just as a quick reminder, it happened multiple times in the past, and it never changed course for Apple in the long run, so that doesn't mean Apple is dead, it just means Apple will change course, and that will not please speculative investors with loads of call options and so on. So that's the reason why I think psychology is driving US markets now. And what I don't like with that is that lots of speculators, Robinhood, whatever, are heavily buying calls options on Apple, and they might absolutely end up wrecked, because remember that call options are associated with leverage trading. This is marginal option deposits, which means the option has theoretically no loss limit. The only stop loss is an option is when you stop having margin to support it. So the thing is that if the liquidity simply disappears on Apple, it is the recipe for a bloodbath. So like I always said, do not trade derivative contracts on Apples at the moment. It is the place not to be right now, but it is the place to look at. Okay, so the place to look at is this, this, and this. Please do not trade these assets unless you're experienced enough, but this is where the party is at play now. Terminating this analysis with cryptocurrency, Bitcoin is the center of the maze. Look at it and don't look anywhere else. Okay, don't give any attention to the altcoin markets and stuff like that. Remember the easiest things I shared with you into the weekly update. This is the only thing you should care about. We still have our taking profit structures as we reached out to the third range boundary. We also have the associated volatility alert, which means in the daily reference time frame, which is the time frame you should have a look at now, well, that gives us 2 information. You need to take some fucking profits, if not already, but you need to be aware of volatility. The volatility boundary is right on top of your head near the 56 to 57K. So this is the area that could be reached out to if the market finds sufficient volatility, but that also means that if you forget to take profits, you might suffer some reversals patterns. Third range boundary, because I don't nearly think, okay, that the third range boundary will pull us right back to the support context. The best case scenario would be reaching out the trend channel. And that's a matter of time. Like we stated, if we go deep and violent with lots of catalysts and wait for this red area, if we go for a mixed feeling in the stock market, in the crypto market, which I definitely think is on the verge to come, we'll get more of a slow downside deterioration, eventually lots of ups and downs, just building an ugly fat range until we catch up on these prices early September, and then we go right back up. Okay, so I don't expect deep retracement. I just expect a boring crypto market. So please stop gasping for 10 to 15% move in a day and start understanding that we're very likely just gonna stay the fuck where we are. All right. So please do not gasp for volatility into the crypto market. Don't use leverage position and so on. Just try to be patient. If you want to play short term, you can eventually do it. Remember that it has to be done at least 2 time frames below the respective range. So we're in a daily range. So go at least for H1 time frame to look for trending opportunities. And this is where we've got it. Okay, we've got a bullish trend, which means whatever the fuck is happening out there is just a matter of experienced traders. That's the reason why anything that happens now, whether that is in the stock market, in the bond market, or in the dollar, or in the crypto and Bitcoin, anything that can be traded is specifically locked for experienced traders. Okay? So if you are not, just be smart enough to understand that you can look at the markets on H4 or daily closes only to gather information if you absolutely want some. But do not do anything else, okay? H1 time frame for experienced traders will be these areas to look for into Bitcoin. Are we closing in here and do we have reversal signal like trying to accelerate and so on? In that perspective, we'll get to short sell into this area. Option number 2, the market validates the current market top, which has a signal, but is not perfect, okay? So we can still go higher for Bitcoin, but if we validate, meaning that we finally get to close below these 50% line, that means we have a validated market top, then in that perspective, the contraction into the crypto market, retracing to the trend line, very likely going to break it in the future, will activate the weekly plan I shared with you guys yesterday, which means the Bitcoin will probably dumbly, chaotically retrace to some more lower valuation, but that doesn't mean it will do it in a straight line, okay? So it is going to be tricky and so on. So if that ever happens, if the market validates the reversal, what you guys can do is wait for a third range boundary opportunity, okay? So that's the hidden message. Okay, either you are experienced enough to try reversals, and there was one opportunity yesterday. I think there's going to be another one today. If there's one, then I'm eventually willing to catch it. Otherwise, if the market validates the reverse by reaching out the opposite context and reversing it, I think there's going to be a third range boundary for you all to take within the next few days. That's pretty much all about it. So that's how you guys need to trade. Have some plan. Be able to forecast what the next market moves could be. What are the next market moves you could eventually try to profit from because you know how to trade these. If you are a beginner, then look for the validated reversals. Look for context reversed, preceded by trends. So if you want to trade Bitcoin, well, H1 time frame is for you the way to go, but you need to wait for the reversal to be validated first, all right? If it ever is, then you know a third range boundary is going to come and you know that this is the one you want to trade. Bye, guys.